G'day everyone, welcome back to Pete's Investing and Trading channel. Today we are trading the CCI14 strategy with the average down, comparing that with a 5% gain and a 5% decline versus the strategy of using the relative strength index with a 5% gain. And we're going to see which strategy is more efficient to trade. Stay tuned until the end of the video where I cover some of my investing rules for safer trading. Don't forget to review our playlist which cover trading strategies, share price and indices reviews. This video will be covered in the strategies playlist. The strategies playlist is where we cover the simple trading strategy, the average down process and some money management ideas. Not offering financial advice, but rather it's an educational series to help you make better trading decisions. Let's get started. I'm about to demonstrate the entry and exit strategy with two scenarios. The first scenario is where we enter the trade when the commodity channel index 14 period crosses over the zero line. We exit the trade when the closing price gains at least 5%, and we average down when the close of the day declines by at least 5% and the CCI14 breaks above the zero line. We then buy double the quantity of shares from the previous trade we made. And the second strategy demonstrates an entry when the relative strength index value of 14 crosses over the 50 line. We exit when the price gains at least 5%, and we average down when the share price drops by at least 5% and the relative strength index crosses over the 50 line again. Note the relative strength index is standard in most charting software, and I try to use these basic entry and exit techniques so you don't have to follow any complex strategies. So let's get stuck into the chart. Now I track share prices for the following companies since January 2021. I do this so I can't be accused of cherry picking stocks that do well. Some of these stocks that I'm going to show you have performed well, others have drifted sideways in terms of the pricing, and others have declined. But as you'll see, they all return positive results as far as revenue goes. The first chart I'm going to show you is the Commonwealth Bank of Australia. This is not it. 2 seconds. So the Commonwealth Bank of Australia, first I want to explain what this chart looks like. So this is a price chart, and I'm going to zoom in a minute. Down here we've got the CCI14, and this is a relative strength index 14 period, with the red line indicating the 50 line. Where it crosses over, we buy. This up here shows the profitability for the CCI14 strategy. This shows a profitability for the RSI14 strategy. And these shows how many entries we made, how many contracts or shares we bought along the way. As you'll notice, this goes back to the start of 2007, right up till today. And today's the 16th of April, 2022. Now the reason I've gone back to the 2007 on this is on a daily time frame. I want to take in the effects of what happened during the GFC, and that's the decline of the GFC in 2008, 2009. And as you can see here, the price went somewhat sideways and made a few advances, and it went sideways and downwards again up until recently in 2020. COVID hit, another decline, and more recently the Ukraine war. So I just wanted to, and I'll zoom into some of these in a few minutes. Let me first demonstrate the entry and exit strategy for a single trade. So here, I'm showing you here the blue bars here represent a single entry, so where it shows an entry on a CCI14, when it breaks above zero, we buy some shares. You can see there, I bought 23 shares at that point there. The price went sideways until it broke above 5%, and that's the 5%, that shows at 6.83, it's roughly drawn. And I've closed it out there once it's gained at 5%, and you can see there it made in that little trade there over a few months, $116. Now here we're trading $2,000 lots on each of these trades. The other one, this RSI14, it's this RSI indicator down here. When it breaks above zero, we buy some shares, and here you can see we bought again $2,000 worth. That's 23 shares, and that kept it open between that period up till there, and until it finally closed out when it broke above the 5%, which it did there, and it closes out when the RSI breaks below 50 again. That's what it did there. You can see that little trade there made $332. Now, before you jump to conclusions, say that's a better trading program, we want to show you what the rest of the share prices did, and I'll show you the table of results in a minute. But that's just a quick example of a single trade. to demonstrate a averaging down trade, you can see here CCI14, we enter some shares there, we buy 26 shares at that price there. The price declined, it dropped by at least 5%. The CCI14 breaks above zero again, we buy more. Now it's got to drop at least 5% decline before we buy any more, so we average down. Now the new average price will be somewhere in the middle there. And it closed out at that point there. You can see there we made from that period, a few months, we made $364 from that point to that point in terms of profitability. The RSI14 strategy, again, we opened it just a bit earlier. The RSI14 breaks above there. We enter our first lots of shares at 27 shares there. We average down similar zone. The RSI14 breaks above there. The share price has declined by at least 5%, very similar to the CCI14. But this one is held a bit longer. We wait for the RSI to break down below the 50s line there, closed out there. And in this point, from that entry until that close of the trade, when we averaged down once, it made $1,292. So again, don't jump to conclusions and think this is a better strategy to trade. I'll show you the results overall in a minute. So what I'm going to do now is show you all the other share prices. I want you to focus on is the actual pattern. So you'll see some of these have gone somewhat up, sideways and down. And we'll go through some of these in a bit more detail. Another one we're looking at is BHP. You can see BHP, again starting in 2007, had a much higher roller coaster ride, more declines during this period. You can see there the average down happened in these periods as well. I won't drill down. I want you to just focus on the share price of all these as we go through these. So again, a decline there, and the average down occurs during the declines. Share price appreciated, those positions closed out. Share price appreciated, small decline there for COVID, another decline there for the Ukraine crisis. But you can see here the total return on the CCI14 was 16,706 versus 11,463. Johnson & Johnson, this had a more gradual rise along the way. More averaging down occurred during the 2008-2009 period during the GFC. Most of the rest of the time, very minimal averaging down, with the exception of this period here. So quite a nice ride for Johnson & Johnson. JP Morgan, very similar results. Big decline here during the GFC for the RSI, not so much for the CCI strategy, but it had a gradual decline. Telefonica in Europe, this is more of a downward trend. You can see here till today, this is still in decline, and the trade is still open. Now you can see here when the share price appreciates, this one actually just closed. The CCI14 just closed out, indicated by that period there, and the RSI is still going. You can see here the RSI is still above the 50, it's still going, and it's doing quite nicely in comparison. Lastly, we'll look at Volkswagen in Europe. Okay, massive average down and hold during this period. So the shares would have been held for a number of years there, beginning at that point in middle of 2009, closing out in 2014. So a big hold there for the RSI. This one closed out a lot sooner in 2011. Another averaging down there, and this one was for the CCI, but another long hold there for the RSI. So let me quickly now go to the results of, okay, this is the CCI14. You can see the table of results, the revenue generated by each of those. So over the years, $86,000. This shows the number of contracts held, and $2,000 for each lot of contracts. So 5 times 2,000 was $10,000 as a maximum at any one point. And this is the drawdown, the maximum drawdown. So it's basically from the highest profitability down to the lowest profitability on the chart. And then this shows just multiplied out or divided out by 183 months since the start of 2007 till today's date, so 183 months, and it works out to roughly $80 per month. So monthly revenue of about $470 for the CCI14 strategy. The RSI strategy, again, you can see I'll let you pause the video and digest the numbers, but this is the revenue. So 74,823, and ignore that, that's just different calculation, but this is the monthly revenue, $409. This is a summary between the two. So you can see here our CCI14 strategy generated revenue of 86,000, maximum drawdown 149. So profit over drawdown was 57%. So we're looking for a higher profit over drawdown number, and that's the monthly revenue estimate. And this is the revenue for the RSI14 strategy, 74,000 compared to 86. There's a higher drawdown for the RSI strategy, therefore a lower profit over drawdown percentage. Not much lower, but was lower on a monthly revenue of roughly $409. So again, if you had to pick one of these, you'd probably still stick with the CCI14 being a better result overall, slightly a better return, revenue return, but also a lower drawdown. So what we've covered: a simple trading strategy with a better probability of price increasing from our entry point. There are many videos which show you how to enter a trade, but most of them don't clearly explain when to exit the trade profitably. In this video, we showed you an effective way of exiting the trade profitably. Note also we don't use stop losses. It's a sure way of minimizing the returns, and more often than not, losing money from your trading account. Instead of stop losses, we use the average down strategy. With some disciplined money management, we show you how to effectively average down and ultimately close out the trade profitably. This approach has been backtested on stocks, CFD indices, commodities, and forex currencies. Again, the key here is good money management approach, especially in trading in leveraged instruments such as CFDs. And today we backtested or trading, that is buying stocks outright with your own funds. That is, we're not leveraging off borrowed money. We show the calculated funds required when following the drawdown approach. We go back to the start of 2007 to backtest with shares covered in the video and show the effects of the GFC during 2008, 2009, and more recently the COVID and Ukraine conflict downturns. On average, we show the returns that would have been generated had you traded $2,000 per trade, which is factored in the brokerage. Note, we don't show the returns on dividends, so any dividend payouts would have been added as extra bonus revenue on the top of the trades made. So some of my investing rules: buy proven blue chip stocks only, avoid speculative stocks. This ensures probability of the shares of the company you're buying has had a good track record and more likely potential of future growth. Buy stocks which pay dividends. Do a quick search of the stock before buying to ensure it recently paid a dividend or about to. This is a good indicator that the company has future potential of growth. If the company recently, that is the last 6 to 12 months, has stopped paying dividends, it may be a sign their growth potential may be challenged for a particular reason. Don't short positions, go long only. Even though our strategy can be applied to CFDs and other leveraged instruments, in this video we only trade in shares we bought with our own funds. That is, avoid borrowing or leveraging funds to minimise risk. Also, if you're short an instrument which pays a dividend, you'll end up paying that dividend to someone else who went long on the same instrument. Do not trade on news. Price is already factored in the share price. If you read an article in the finance pages which talks about an event on the stock you are considering, the chances are it has already been factored in the share price. So you've missed that boat. I did a video in September 2021 titled Uranium Stock Too Late to Trade, which demonstrates the effect that news has or hasn't and the share price action. Suggest you watch that video. Thanks for watching. Don't forget to click the subscribe button and like button and the notification bell to get updates to the channel. Happy investing and see you in the next video.